Welcome to the Way to Build Wealth. I'm Ethan Bloch, that's Warren Buffett, and together we're helping you build some wealth. Welcome to the show on a Tuesday, and as we always do on Tuesday, it's a Tea Time Tuesday. Today I'm drinking a very simple green tea from the company Organics. I've had this before, very simple, nothing, no spices or herbs or other flowers in the green tea to make it taste anything other or like anything other than green tea. If you never had green tea, it's kind of weird in one hand, and on the other hand, it's pretty bland, I think.
So
It's an acquired taste. First time I had it, I was like, wow, this is not very good. And now, after many years of drinking it, I really like green tea. It's somewhat refreshing, it's healthy. That's enough about green tea. Let's get into the show today. Today, we're talking about 2 easy ways to protect yourself from inflation. Or as I like to say, and sometimes Warren likes to say, the inflation monster. If you want to know more about inflation, linked up down there is an episode we did quite a while ago. I believe it was episode 4 or 5, talking about, the inflation principles and why it matters and why you should care. I'm not gonna get into it now. The reason I'm bringing this up today, there's a couple reasons. The main reason is, just last week, the Federal Reserve, which we should probably do an episode on down the road, got a lot of, we're making lists for all this stuff. Tim's got the list, probably not. In the head. It's never good. Get things done, put it on paper. Anyway, the Federal Reserve slashed the key interest rate, or the Fed funds rate, to 0.25%. Fed funds rate, again, I guess this is something else we should talk about another day, but it's the rate at which banks in America should lend money to each other. They try to target the rate. Anyway, this is the lowest Fed funds rate on record, 0.25%. To break down the whole economics of the Federal Reserve and the whole situation in a very simple way, whenever the Federal Reserve lowers interest rates, it theoretically and practically pushes more money into the economy. And by pushing more money into the economy, you have more dollars chasing the same amount of goods in the economy. So what happens in simple supply and demand? You have the same amount of goods, but more people or more dollars chasing it, the price of goods will go up. That's inflation. Very simple way. So when the Federal Reserve lowers interest rate, it indirectly is a tax on everybody in the country, or could be. In the situation we're in right now, the fact that no one's lending money is the problem. Even though this rate is cut low, no one's lending money in the economy. And that's why we're all breaking down. That's why it's called a credit crisis. So when no one's lending money, it doesn't really matter. So they're taking drastic measures to try to increase liquidity all throughout the economy, through the Fed funds rate being lowered, as well as through the Federal Reserve just going out and buying up toxic assets on their balance sheet. So, that being said, I think I slightly lost my train of thought. At this point in time, we are not going to expect inflation. Now, going forward a couple of years, depending on how this situation materializes, we could have extreme hyperinflation in 5 years, in 10 years, I don't know. I can't, speculate on these things. So it's important that you have some inflation hedges in your portfolio. Now, as I talked about before, common stocks in their own right are protectants or protectors against inflation. The businesses, because they're real businesses that can higher prices, they're going to decrease profit margin when inflation starts kicking up. But another great way to protect yourself from inflation is through buying inflation-protected securities or Treasury inflation-protected securities from the U.S. government, as well as savings bonds, which are Treasury, inflation-protected savings bonds. They're actually linked to the rate of inflation. You can buy both of these through Treasury Direct, which we talked about a couple days on the show. Very simple way to do it. Set up an account, no transaction fees, no commissions, and you can start buying increments of these. I believe in I-bonds, there's a $50 minimum, and in TIPS, there's a $100 minimum. Now, there's a lot more about each that I'm going to link up down there. There's even a comparison to show you the difference between the two, because one's a savings bond and one's just a normal bond, for that matter. And the difference is you can't get your interest out of the I-bond until you cash the bond out 10, 15, 20 years from now. So that's the gist of it. That was a lot. Do you think that was too long? Tim's like, oh, we might be reshooting this one. I don't know about that. Hold on a second. So those are the two easiest ways to protect yourself from inflation, other than obviously holding stocks, but two new ways, I guess I really should say. And I hope that whole explanation in the beginning helped you understand, why it's important to protect yourself. Again, inflation will destroy your purchasing power and make you poorer, whether or not you can physically see it in how much money you have or not. It's going to happen. It's going to strike you, and you'll be like, dude, what happened? Inflation monster breaking down the door. It could get really ugly. That's it for the day. I'm Ethan Bloch, or me, Ethan Bloch, with Warren Buffett, helping you build some wealth.